Broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, and nice to have you with us on the 27th of November. Apologies again for the problems, technical issues that hit us last month, but we are back again, and I hope that those of you who weren't able to get through last month have now been at least able to listen to the podcast. What I did do was go through the presentation and put the podcast up onto Biznews, and I know it was pretty well listened to, so that's good news. Thanks for being with us. We'll be going through the portfolio today. I'll be obviously, as always, taking questions, but here's my partner in crime in Johannesburg. I'm in London, by the way. My name's Alec Hogg, and Stuart is in Joburg.
Thanks a lot, Alec. Yes, apologies for last month, everyone listening. Just before we get into it, can you please raise your hands just to make sure that you can hear us and see the first page? There we go. Excellent. Very quick on the button there, Alec. And as Alec mentioned, we do like to get the questions in. There's little questions drop-down menu on the control panel on the right-hand side. If you just plot them in there, I'll pass them on to Alec as he goes through the portfolio. But I think that's it from my side, Alec. Ready to roll.
Brilliant. And just to make sure that you know that I'm not a cardboard cutout, but not somebody who's going to be imposing this face on you, the face for radio, for very long. Just to let you know, here I am in London. This, by the way, is not my choice of wallpaper. The wallpaper has got nothing to do with the English rose either. I don't know what kind of do you know what kind of flower that is, Stu?
Unfortunately, I have no idea, Alec.
But as happens with most South Africans, this is a rented house that we are staying in. One day you might be able to purchase with these London house prices. But anyway, it's good to be in the center of the universe, as it is certainly in the center of the financial world. And let's get into the portfolio because we've got lots to discuss today. Starting off with the October wipeout. Hardest hit from September. What has happened in November? And I wanted to start with this graph or this chart rather, just to show you that in many ways we've had a stabilization of the portfolio. When we looked at the portfolio last month, because remember we were taking October on the highest point, which was in September, you could see there that Amazon had suddenly become one of the worst performers in that month on the whole of the American stock market. In our portfolio, it's a dominant stock. It was down 22% in a month. Tencent dropped 21, Alibaba down 19, and Alphabet down 14. Those losses have been trimmed a little, as you can see. Big rebounds in this past month by the two Chinese groups. Tencent is now only down 6% off its peak in September, but it's been falling for much of the other part of the year, so we'll give you that insight later. But a big recovery for Tencent, and similarly for Alibaba, two stocks that were really hard hit by the wipeout in October. And when you have a look down a little further, you'll see that the real hit came to Apple. Now, a month ago, when we did the last webinar, Apple was only down by 4%, so it was a hugely resilient in a market that had dropped by more than double that, and of course tech stocks that had taken a real hiding. But concerns about what's going on in China, the threat that came through from Donald Trump that he may well no longer exempt Apple iPhones from the tariff war. He's really getting hot under the collar and starting to now get even more antagonized after last night's announcement from General Motors that they're going to be closing down 4 of the factories in the United States, and that's going to put 15,000 Americans out of work. And they have named the tariffs as being one of the major reasons for it. The tariffs that have added $1 billion to their bottom line expenses. Similar story to what happened with Ford Motor Corporation, where the tariffs there have also going to cost them $1 billion. In fact, Ford has said they will no longer be manufacturing cars in North America into the future. The reason for that, the tariffs, by the way, we're talking about steel and aluminium on both of those issues. So Donald Trump's got himself in a bit of a twist-stunt, and as a consequence of that, Apple has been, from the most resilient stock a month ago, has been the one that has been hardest hit in the past 4 weeks. Having a look at those that were in line with the market, Adobe has softened a little bit in the past month, which is unusual. It's continued to fall, but the other three have all recovered ground. Berkshire being the biggest of it, up by 5%, and then Apple being the one that fell back. The consequence of this on our portfolio is that the portfolio is a little bit stronger in US dollar terms to where it was in October, suggesting that things are now starting to stabilize. And it is down, though, from the September peak of $390,000 down to $339,000. Remember, we started this portfolio 4 years ago, exactly 4 years ago in this reporting period. We actually started on the 5th of December, and it's going to be the closest reporting period to the 5th of December. And the portfolio is now down by 13% over that period.
Sorry, Alec, just quickly, Dar wants, with the Apple fallback, Dar wants to know, is it a time to be buying more of the stock?
Of Apple stock?
Yeah. Apple.
Yeah, we can get into Apple in more detail in a moment. What's happened there is that initially Apple was resilient because it was excluded from the trade war. That was the thought. Remember, Apple is extremely exposed to sales in China. And as a consequence of that, if there is a problem going on in China, then you will have it would be affected worse than most other stocks. In this case, though, Apple is not has no longer been exempted, and as a consequence of that, it's now been the hardest hit. Is it worth buying in? It's probably, the decline has probably been overdone. And as a long-term bet, you're betting alongside Warren Buffett. Stuart, I've just got to pop out here as these things happen when you're live. Would you just explain again how people can put through their questions?
No, for sure. Just a quick recap. There's, on the right-hand side control panel, there's a little drop-down questions menu bar. If you put them through there, I'll pass them on to Alec, but just plot them in, just write them in there. Yeah. I've got if there's anyone else with issues with or visual, because I see Terry, I've got an issue with visual, but I'm not sure if he's the only one. If anyone else, let me know, because if it's just one, I'm not sure how to fix that. But if it's all, we can relook. But I can see the portfolio on my side, so I'm not sure if there's other problems from listeners. Just let me know in the questions. Okay, there, Andrew says it's fine. Okay, cool. Thanks a lot, Terry. I'm not sure how to fix that, unfortunately. I know you've rebooted, but yeah. Anyway, back to you, Alec. You're back.
Yeah, I am. Apologies. We have a little, well, okay, I won't go into the details, but I do own 2 Jack Russells, and I could hear them getting quite unhappy in the background. So if you just indulge me for a minute to sort them out. Okay, let's get back into the portfolio. As you can see, it has grown from 200,000 to 339,000. And that is good news in US dollar terms. But of course, more important is what happens in rands. And the annualized return of the portfolio since inception 4 years ago has been 28%. So if we go back 4 years, if we go back to December 2014, and we'd said at that time, what kind of growth would you hope for in a portfolio that you are wanting to hedge yourself against the South African rand because you're concerned about Zumanomics, etc.? And if I told you then we'd be giving you 28% in those 4 years, I've no doubt that all of us would have jumped and put as much money as we possibly could put into it. It's been an incredible performance, and primarily because of Amazon, into which we invested just under 200,000 Rand, and it's now worth more than $1 million, 1.1 million, that investment. And although Amazon has now become a very big part of the portfolio, as you can see, around 25% of the portfolio, I have no intention whatsoever of recommending that we drop it or even reduce the share. What I would say, though, and it has been pretty volatile in the most recent period, is that if you find volatility difficult to stomach, if you're looking at this and you're saying, my goodness, we had a portfolio that, as you can see, in September was worth nearly 5.5 million Rand, and now it's only worth 4.5 million Rand. If that worries you, if that bothers you, then you need to be able to put yourself into a position where whatever you have exposed to this portfolio enables you to sleep well at night. My sense of this is really that we're looking to buy into companies that have got great value and good prospects. And we hold on to the stocks for as long as there's not a fundamental change in the business, or as long as or until they reach full potential. Now, when you get exponential companies like those that we have in this portfolio, and when those exponential companies are still growing at between 20 and 30% per annum on the top line, let alone on the bottom line, that to me means they're a long way from reaching full potential, certainly in a world where inflation is running at 2 to 3%. So that's really the strategy of this portfolio. It will be volatile. Mr. Market wakes up some days and he feels terribly depressed. It's like the whole world, what are those wonderful Asterix comics? The sky is going to fall on the head of the leader or the chief. And it feels to some people as though the sky is falling. Well, if that happens to you, there's no need for you to remain hugely exposed to this portfolio. Rather, take a deep breath, maybe sell half if that makes sense to you. But we are going to remain fully invested, and we're going to remain fully invested in stocks that we believe are going to outperform the market in the longer term, because the companies are going to outperform. Remember, when you're buying or when you're investing in a share in the stock market, you are buying a slice of a company. You have to be a co-owner of that company and know what that company is about. And as a consequence of that, you will then be able to reap the rewards if the company achieves what you think or what you initially bought into it for, achieves that into the long term. There is a fall here in rands of 14.7%. So it's a bigger decline in rands from the September peak than the decline in US dollars. Reason for that is the rand has appreciated quite smartly in the past month. And it's gone up, as you can see, from over 14 to under 14. So a nice appreciation there in the South African rand. And as a consequence of that, we have, that 1387 is actually the most recent price. That's in November. And I didn't, it's not the 30th of October. It's actually the 27th of November. We're at 1387. And at the 27th of November, we are at 177 against the Hong Kong dollar. Not much move in that one, but a nice movement there on the rand dollar rate. Overall, that improvement tends to tell me that the world is looking at Ramaphosa and saying, this guy is getting his act together. So in many ways, you can almost say the original philosophy of investing offshore, investing away from the Zoomonomics, has now been taken out of the picture. And I've got a sneaky feeling that the South African rand will probably be a lot more resilient going into the future than it has in the last few years. It has deteriorated over this period by about, more than 20%, nearly 30%. So that original bet that we made of investing offshore against Zoomonomics was a very good bet. But on the other hand, where it goes to from here, when you get sensible investing of the country's resources and the end of plunder, etc., that would probably suggest to you that the rand is not going to be as vulnerable as it was in the past. So just bear that in mind when you're doing your offshore investments. When we go back to the portfolio and you consider what happened during the last month, and you saw those big declines, I also like to pick up what happens or what has happened to the stocks in the year to date. And there you can see both Amazon and Microsoft have been unbelievable performers. Berkshire has outperformed the Vanguard VOO, which is the S&P 500 index. And that is the market generally. That was 0. The Berkshire share price was up 7%. Apple a little bit above the market. Alphabet a little bit below the market. And out of favor, excuse me, were the two Chinese shares. But both of those have improved quite considerably on what they were standing out a month ago. A month ago, you had Tencent trading at a far worse decline than the 27% that we're looking at right now. So there is there has been an improvement in Tencent's share price, and that is trimming back the losses that both Tencent and Alibaba posted in the year to date. individual stock performance, there you have it, with the Rand 23% weaker from where we began, and the other stock prices give you a very, very good insight into where the performance of this portfolio has come from. The overall index in the United States in Rand terms is up 60% in the 4 years, which is, again, reaffirms the decision that we took there to switch away from Zoomonomics, to take the money offshore and to put it into US shares. At the time, I remember many people were punting Europe as a better opportunity. Well, we didn't go in Europe. We went exclusively in the United States pretty much. We did buy a couple of European shares, as I'll touch on in a moment. But primarily we were in the US, and that decision alone has been a good one. If you could have put on 60% in your portfolio in 4 years, I don't think you'd be unhappy given what the JSE has done over that period. And as you can see, an interesting point there with the recent decline in the Apple share price, it's actually underperformed the market as a whole, as has Microsoft, although that's unfair for Microsoft because we only bought into the stock recently. But Apple, Microsoft, Adobe has been a little, it's up 14% in Rand terms, so we bought it in the right time as far as the Rand is concerned, and then Tencent and Alibaba showing very slight increases. And there you have the profit since purchase, Amazon.com showing, well, in fact, all of the stocks in Rand terms giving us a positive return, even Alibaba and Tencent, despite their decline in US dollar terms. And I wanted to just play a little bit on this because it is a, if you could just have a look at that for a moment. Novo Nordisk, Barclays, IBM, Metrobank, Tesla, and Facebook. Those are the 6 shares in the last 4 years, because I guess this is a bit of an anniversary. Those are the 6 shares in the last 4 years that we have had in the portfolio. Sorry, Stu, will you pick it up again? Sorry, I'm going to switch that phone off.
No, sure, Alec. I've got some questions. I mean, I can answer. Let me see.
Isn't that funny? I mean, we're just having one of those days. If it isn't the Jack Russells that are disturbing us, it's the telephone. But anyway, I've put that one on silent now. Hopefully he's not going to phone my other phone, a South African phone. But what I want to do, the point I wanted to make here was that our decision so far to change the portfolio where we have, and there we have those 6 stocks. The decision to change the portfolio has actually worked out to the good, in that the only one that we sold that has actually risen is Tesla, which is up 37%. And honestly, I can't own Tesla shares right now. I don't think I'd sleep that well at night with it. It is so volatile. And when you have Elon Musk in there and you have all the short sellers of Wall Street trying to push him down, it really is a problem. It is a stock that you've got to have nerves of steel, and I'd rather go to the races and have a bet on a horse that I like. So as outside of that, the sales of the other shares have actually worked out in the right way. We made a profit on Facebook, as you can see there. We sold at $155. It then promptly went up to over $200. It's now at $136. Metrobank, we got out. I thought it was going to be a huge success story. There was a scandal, and we always do when there's a scandal, we got out, as we did with Facebook. There was a scandal there. Now we can see the consequence. The shares down by 1/3. IBM, we followed Warren Buffett out of the stock at 152, even though we had bought it a little bit higher. And there you can see it's down 22% today. Maybe worth looking at again, IBM. I'm still a little bit dubious about that, but it is a possibility. And then Barclays, a scandal again. We got out at 220 or £2.20 there, and it's now at 167. And then Novo Nordisk, again a scandal. We stayed. The share price actually went all the way down to the early 30s. In fact, below 30. And $30 a share, and it's now come back to 46.17. Okay, Stu, just over to you for a few minutes to see how those
questions
for a few seconds, right? Yeah, just to see how the questions are going.
Alec, there's just a few, obviously you'll touch on Apple, there's just a few people concerned about the growth horizon and new products, but I know you'll touch on that later. There's an interesting one here from Dostian Company. He says, why only 1% in cash? Should you not like bigger positions you have?
It's a very good question, Doe. A very good question. Essentially, I don't know how to time markets. I'm not clever enough to do that. So all I can do is to have a look at the way that the underlying shares are performing, the underlying companies are performing, and then to make a decision on whether or not to own those shares for the long term. When you get to a position, as we were in September, where the annualized return on this portfolio was 41%, it becomes a question, I guess, of saying, can you continue to run at that level? If you are worried about levels of markets and you want to increase your liquidity to a portfolio like this one, go for it. I'm not clever enough to do that. I really am not. I am thinking, and I'm thinking very hard at the moment about the prospects of the UK, because I get a really good sense that sitting here, that Brexit's actually going a lot better than most people have anticipated. And in fact, that the market is still pricing for a disastrous Brexit. So the pound is still a lot weaker than it was prior to the Brexit decision. And there are lots of other issues that are coming in as a consequence of that. But it is not something that, and so that you might find by looking at UK shares that you can then reassess what is happening in the UK, and those companies would then look like they'd been hugely oversold. And there are a few of them that I've been looking at. But as a long-term basis, it is the stocks that we're buying, not the markets themselves. So I'm not going to try and time Mr. Market. Stu, I apologize, but you're going to just have to take it for another minute, please.
Sure, Alec. I'm just a bit lost on how to take it, but it's all good. Let me see. Joanna asks the returns after fees. I'm not 100% sure. I'll ask Alec that one as soon as he gets back. I'm not sure fees are taken into account, but we'll check with that. Good time to buy Amazon. Sorry, Evan, we'll have to wait for Alec on that one. I would suggest it's always a good time to buy Amazon, as Alec mentions, with the company itself, but I'm sure he'll have his own views on that. So not sure on that. And Joanna asks, is it too late now to invest in dollar shares? I'm not sure, Joanna. I don't think it's too late to invest in the US stock market, but Alec will obviously have his views on that as well. I'm not sure what this distraction is this time, though. But yeah. Excuse the silence. As soon as Alec comes back.
Okay. All right. Apologies. That'll be the last interruption. Okay. Yeah. What a story. All right. Shall we hit into those questions? Yeah.
So, Alec, Joanne just had two questions. Just want to know, is it too late now to invest in dollar shares? And then also, are there returns after fees? I'm sorry, I see we've just lost your presentation, Alec. I'm not sure.
No worries. What I wanted to do there was actually to start going into something else on the site. Are the returns after costs? We used to do that, but essentially what we've been doing now is having a look at the returns as per being able to trade only once a month. So you should be able to buy into the stocks at less than the prices that we're paying for. And the pricing, so in other words, if you have a look at the prices that we pay for the shares, and because we spread it out over 3 months, it is an opportunity for you to buy cheaper. We don't have that opportunity, but essentially what we do is we take the highest purchase price in. It's small numbers, but I guess in the long term, it is quite important when you have a look at the impact that those shares do have. What I've been trying to do here is just have a look at some of the individual shares in the Wall Street Journal. Those of you who have triggered your subscription, would obviously have the Wall Street Journal access from Biznews. And just to show you what's going on with Apple, because there was a question with Apple earlier. Stu, can you see it on the screen?
Yes, Alec, it's all good this side. Eh? Perfect.
Okay. As you can see there, the Apple share price held up extremely well in October. Right towards the end of October, it was still trading very much at the level over $200. And then suddenly it took a tremendous slide. Now, what you need to do is, if you love the company, if you understand the underlying business, and I really do love Apple as a stock. For a while now, we've been saying, in fact, for 2 years already, we've been saying that the real appeal of Apple doesn't lie in the sales of its iPhones, but it lies in the ecosystem that's being created around it. Some months ago, it was announced that Apple has 1 billion of these devices in the marketplace. So those 1 billion devices are owned by people who can then manage those devices into, they can access the Apple software and the Apple services. And as a consequence of that, that is what I like most of all about the company. When you look in the long term, you've got an ecosystem. I'm an Apple subscriber to pretty much everything that it provides. And as a consequence of that, I know that it's all integrated into my laptop, my iPhone, my desktop, my iPad. Everything is integrated together, and I use their products, and I'm quite happy to pay for services that they give me. That is the real benefit to me of Apple. And it's interesting to read some of the pundits now saying that the company is trying to project this as the benefit of the business going into the future. I think it's been pretty much an obvious one. So if you look at Apple and you say to yourself, is it now the time to be buying into the stock? Well, at around 175, you're getting a lot more Apple shares for your rands than you were getting at 225. And in particular, because the rand has improved from around 1460 to the level that it's currently trading at. What I'd also like to just pick up as we're talking about graphs is, again, on the Wall Street Journal, and I really urge you to use this charting facility. It's got every single stock, every major stock in the world, including South African shares, are there. And you can see here is the rand's performance, and of course you can go to different days, but let's just look in the last month, because that's the period we're talking about. In the last month, the rand has gone from 14 rand 72 to the US dollar to its current level of 13 rand 85. So after the initial jolt that came in October, and you can see that little bump there went to 1542, and then the rand during this time here in October, it had got down to 14, went almost back to 15 again. After that jolt, it has stabilized and it has improved. As a consequence of that, of course, if you're investing offshore, it means that you can get more for your rands today than you could have got a month ago. Stu?
Thanks, Alec. There's a question from Ian. He just wants to say, is the market price correction over the last 2 months just a blip or the beginning of a collapse?
Again, I don't know that. I can't, and I just wanted to show you all the South African stocks are also covered. And there's Naspers on the screen for you right now, also covered in the Wall Street Journal. And there's fantastic, those people who like technical analysis, there's chart overlays. You've got whatever you want to put in there, apart from all the news stories that comes with it. When you talk about, is it a collapse or is it a long-term buying opportunity, my sense is that markets as a whole, and I think I learned this in South Africa, is that when you start talking about the market, you are finding yourself, you do get yourself into a bit of a nonsense conversation, because the South African market, or the JSE, is made up nowadays of the bulk of the stocks being offshore shares. You think BAT, Richemont, InBev, and well, you could keep going. And most of those companies actually generate their profits outside of the country rather than inside of the country. And then when you look at another, so if the rand were to weaken, those shares would go up anyway because they get a better pricing in rands. And then you have a big chunk of them who are companies that are invested in the resources sector, and there you have different issues that affect them too. And then you would have a stock like Sasol, which is interesting to have a look at on that one while we're talking. And Sasol's share price is impacted not so much by how well the company is performing, but by the oil price. And the way you can look at that is very, very easy, is just to put a let's have a look at it, compare it to the Brent crude oil price. Okay, there we go. That's the one we're looking for. There we go. So as you can see, the Sasol share price, doesn't matter how well the company performs in operationally. Look at that. It's a dead ringer. We're talking about in the last year for what happens to the Brent crude oil price. Sasol follows, sometimes it's a little bit out of kilter, but primarily it is following the Brent crude oil price. So that's saying to you, how can you then say you're buying the market, or is the market going to crash? Has Sasol crashed? Probably. If you were to talk about what's happened to the oil price, which is down, as you can see, 40% in just over a month, Sasol has done the same thing. It's also taken a tumble in the past month because of the oil price. But is that market going to, is the oil market going to recover? That's the question you need to ask rather than the market generally. When you have a look at the Johannesburg Stock Exchange overall index, you'll get an understanding that too has been affected this year by international events. So Donald Trump sneezes and the rest of the world catches a cold. Do I think that we've reached a bubble area and that things are now going to be falling apart, that we will find that there will be a collapse in certain shares that have been really good performers? Well, if you have a look at Amazon over a lengthy period, there would be an argument, certainly, for saying that it has gone up. There we go. There's the Amazon share price over 10 years. Let's see it over 5 years. You can see it's gone from, well, where we bought it in 2014, from around $325 a share to over $2,000 a share. Is it about to collapse as a consequence of that? Is it worth those kind of high multiples? My sense of this is that when you're buying into a company that's growing 20% plus in the top line and the bottom line every year, and it can actually, with an app or Amazon, it can switch on the profits anytime it wants to, given Amazon Web Services, etc. And the way it's now moving into advertising, that's a very big story in the Wall Street Journal this week, was exactly that, about Amazon advertising. There we go, Amazon ads. We'll get to. I just wanted to show you something on the story that came out, which will give you an insight into where Amazon's going, or where the opportunities are for Amazon. And that's the graph. I hope you can see that. But it shows the digital ad revenue. The blue line, the strong blue line there, the dark blue line is Google. The lighter blue line is Facebook. And then the yellow line is Amazon. Now, no one would have thought of Amazon being an online advertising option. It's not what they do. They sell things online and you buy them and they deliver them to your home. But as you can see, this is something that Amazon is now moving into progressively. Not good news for everybody else in the media sector, particularly not the newspaper groups. But it shows you that this is a whole new area that Amazon is getting into. And once it has the base that exists, as it moves into new areas like this, as it is doing in the food market, for instance, in the fresh food retailing market through the acquisition of Whole Foods, then it starts adding huge bottom line numbers. So is this going to reverse? Is Amazon not going to find new opportunities to get into as a consequence of that? Should we be worried about the Amazon share price at the current levels? No. Because you aren't talking about Amazon in that way. That's not the kind of story that, or the reason why we've been buying into these shares in the first place. I that explains it. The market, anything can happen to the stock market. Mr. Market can wake up tomorrow and feel terribly depressed and then decide that he's got to sell everything, and all shares could fall as a consequence of that. That would be, to me, the opportunity for people who are wiser, who have done their homework, who have had the benefit of some education and insight into the individual shares that they're holding. It's an opportunity for them, for us, to acquire more of them. This old story of what we always used to call Rand cost averaging. You buy more when prices are low. Are prices as low as they're going to go? I haven't a clue. But what I do believe is that these kind of levels, given what we've seen in the last month, after the sell-off the month before that, they are now starting to stabilize. And that could suggest that they're good opportunities to buy into companies that you'd have to pay a lot more for previously.
Excellent. Thanks, Alec. There's a question from Masheba on your take on Nvidia. I know we don't have it in the portfolio, but just your thoughts.
Yeah, Nvidia. You see, that's when you don't know enough about a company, it's best to not pass a comment. I do know that Nvidia is one of those highly volatile stocks. It is one of the most heavily traded on the New York Stock Exchange, or on NASDAQ rather. And as you can see, it's also been one of the hardest hit. Now, if you bought Nvidia shares and you know the company and you know why you bought into the company in the first place, and you have a look now and you see, hey, I'm getting the stock at, what's that, mid-2017 prices, well, then you've got to believe that you're buying in for the right reason. If, however, you were buying the shares hoping to sell to a greater fool and actually didn't understand the underlying economics of the business or the reason why you were buying it, which is where I would be sitting if I bought them today, then you're probably best just staying away.
Excellent. Thanks, Alec. I've got no more questions from my side. I'm not sure that we've actually got through them all, which is a good sign, I think.
Well, that's a good sign. Okay, well, I can go back into the portfolio then, and just we can just pick up on a couple of things on where we would be going to from here and why the portfolio is structured the way that it is. While we wait for more questions, generally speaking, the idea of this portfolio was that we would invest in hard currency stocks because in 2014 we were very worried about Zoomonomics. There are other issues that bedevil the South African economy, but thankfully Zoomonomics are not one of them anymore. It also is, though, quite sensible when you are investing to invest in areas where you can find a greater choice. Now, South Africa makes up less than 0.5% of global GDP, less than 0.4% of the stocks that are listed around the world. If you want to buy on the Johannesburg Stock Exchange, for example, a tech company, you're really only left with Naspers, nothing else. Whereas you can see we do have Naspers, I suppose a proxy of Naspers in our portfolio through Tencent, but we bought that one in Hong Kong. But there are thousands and thousands of shares around the world that you can rather buy than outside of the JSE. So the idea of investing outside the country is a very good one, just to balance, to give you a greater choice and to balance your investment opportunities. The negative thing that you have there is, while I sit here in the UK, I can see what Amazon are doing to this market. I can see what Apple, what excitement is created around Apple. I can see how Microsoft's change, when you go into the stores and you see how Microsoft's change to its monthly annuity income program is affecting and is assisting its efforts in a first world area. I can also see that the Tencent are not really represented here, but you almost exposed from a place like London to the hugeness of the Chinese market and its economy, and an understanding that it's Tencent owns the browser as everybody opens their cell phones, and as the world is moving more away, more to cell phones or mobiles from the desktop and laptop computers, what that impact has. But when you are sometimes sitting in South Africa and being geographically isolated, it can be difficult to get a good feeling, get a feeling about the stocks you should be investing in. And that, I think, is one of the reasons why the home bias is so strong in a South African context, even though there are better alternatives outside the JSE, because there is also exchange control in South Africa. You would have the stock prices of some of the stocks inflated relative to identical peers that you can find elsewhere in the world. So, as a policy, you should be investing you should be investing your money offshore. As a second policy, although I am fairly bullish on the rand in the medium term, in the longer term, any country which has a higher inflation rate than its trading partners is going to have its currency depreciate. So you've also got to look at that. And of course, South Africa is a developing market, and there are shocks that can hit you anywhere from all sides. The risk in a developing market is higher than in a developed market. It's like the risk of a young democracy versus an old democracy. So that's also a reason to have some of your money offshore.
Thanks, Alec. There's a question on Facebook. Harry just wants to know, are you still negative on it? He's still holding them and wants to know if he should sell.
Now, again, sitting here in the UK, you can see what Facebook are doing. They're going through a restructuring, a substantial restructuring, because there has been enormous attention on Facebook, on on big tech generally, and I'll call up the share price so we can have a look at it. It is part of the reason for that has been the Cambridge Analytica story, which still hasn't gone through. It still hasn't rather worked its way out of the system. We do also have a concern or a problem when it comes to Facebook on what has happened recently in the company on. Sorry, I'm going to just stay. I'm afraid I'm going to just have to stay with this. My computer's not really playing ball as far as Facebook is concerned right now. But we're also having a problem with the way that Mark Zuckerberg has been managing the business. Recently, there have been some concerns over Sheryl Sandberg's role and continued role there, and etc. But take the management aside, take away the fact that they've got some fantastic products in WhatsApp and of course, Facebook itself and Instagram. But where Facebook is exposed is in its management of social media. This has now become something that the authorities or the regulators around the world are paying more attention to. And Facebook is also very much in the firing line when it comes to the whole story of fake news. One other big thing that people often forget about Facebook is that Facebook has almost a negative audience in its field from the media, because Facebook does not share advertising revenue with its media partners. So what Facebook does is it provides a platform, and then it gets its users to give up their information and to provide the content, if you like, and Facebook takes all of the advertising revenue. Now, when you are comparing that with Google, for instance, Google shares 70% of the advertising revenue that it gets from websites that run its adverts. It's a huge difference, and it makes Google a far more sustainable business model. At some point in time, Facebook's 50% profit margins, are going to come under pressure. So, do I like it? No. I think that's in a long roundabout way. The fundamentals of the business are changing. When you are running at excessive profit margins, eventually they do come down to earth. And we seem to be experiencing that with Facebook, quite apart from all the other headwinds that it's facing.
Thanks, Alec. Just a little question from Joanna. She wants, if you want to start investing offshore, what is the minimum value you would suggest to invest to minimize the entry cost?
I guess that depends on what the costs are going to be. I would say, if we can just put it into a South African context, I would not in a South African. I would work in a South African context of where you can invest, if you're using a traditional stockbroker. This is where you can invest 10,000 Rand per stock that you're investing in, and I haven't had sight. I haven't looked at the web trader costs or pricing recently, but I would suggest that you're probably talking about, if you just work that back, you're probably talking about $1,000 per individual purchase. So if you are purchasing for less than $1,000, you probably are going to be paying costs that exceed a reasonable level. Like a lot of these things, what you should be doing in that case is buying an exchange traded fund. So you could go for something like the Vanguard S&P 500, where the costs are low. In fact, there's a lot of fighting going on at the moment in exchange traded funds between Fidelity and Vanguard, where Fidelity have dropped their cost. Now, get this. Their price to buy a Fidelity fund is it works out to 15 cents for every $1,000 that you invest. 15 cents. So if you're going to be, and Vanguard is actually following suit. So if you're going to invest in an exchange traded fund, if you're starting off and a question is, how much money do I need to put in? I would suggest you actually, until you got kind of $10,000, I would be putting that money into an exchange traded fund to reduce the cost to the minimum amount.
Thanks, Alec. There's a question from Alan. He wants to get your thoughts. Will there be an impact of investment shift what will be the impact of investment shift into bonds on the US blue chip stocks, if at all, if with this shift of investment strategy? I think he's getting at, Alec.
Yeah, I don't think. Okay, let's just look at investment theory 101, which says that when interest rates rise, you should be moving out of equities. Now, in the United States, everybody, and I talk to my good pal Edwin J, who lives in California. I talk to him often, and he tells me that the talk there is that the market is really, the economy is going really well, but people are feeling, what's going to happen next year? And when you then follow the pundits in the United States, that's coming up more and more. We've had this adrenaline hit that Donald Trump gave the economy with the tax cuts, which appear to have benefited investors rather than creating more jobs. Not that they need more jobs in America with only 3.7% unemployed, but it is a feeling that next year we could see a economic downturn, or at least a reduction, a significant reduction from the 4% growth rate you're seeing right now. What that does is it then puts pressure on the Federal Reserve to not hike interest rates as aggressively as they might otherwise have intended to do that. And as a consequence of that, you don't have the bond market falling out of bed, or the shift that you get into equities, which was traditionally used to happen. What we need to overlay on all of this, and this is what this portfolio is all about, is that the world has changed. You all you need to do is just compare Amazon with Walmart. And when you have a look at the performance of those two companies, and you have a look at the performance of the two share prices, you'll get an understanding of what I'm saying. Here, when Amazon.com is growing at 20%, between 20 and 30% a year, Walmart is lucky to get single-digit growth because its market is being sucked out. We have an example of this, a very close example in a South African context with Mattress Firm, which was bought by Steinhoff for nearly $4 billion 2 years ago, on the understanding, probably at the time, that Amazon would not be going into mattresses, and that at least there was these big ticket items. If there's one sector of the economy that's not going to be exposed to the Amazon effect, it would be these big bulky items. Well, that's proved not to be the case. And we then saw in the last couple of months, Mattress Firm being put into Chapter 11, protection from creditors, which means the almost $4 billion that Steinhoff shareholders paid for it is worth an absolute nice round zero. And as a consequence of that, of the Chapter 11, they've had to give up 50% of their equity to banks just to keep the lending continuing. So it wasn't the case of Mattress Firm getting anything in return for the 50% of the equity that it had to give up to the banks. It's just a case that the banks say, all right, we'll become 50% equity partners and we won't pull in our loans. Otherwise, there wouldn't be a mattress firm today. So it just shows you how quickly the view of a company or the prospects of a company can change in this world that we are moving into. So where you want to be in this world, you want to back the winners. You want to be with the winners, like in life. Go with the optimists. Go with the winners. Stay away from the losers and the people who are going to talk you into a downturn. And in investing terms, it's the same kind of thing. So it gets back to a question that we had a little bit earlier. Is the market going to crash? Well, some shares relative to their prospects are still hugely overvalued. Other shares relative to their prospects are undervalued. And their prospects depend on your understanding of exponentiality and how if you can embrace exponentiality in your mind, then you can find a reason for buying Amazon, as we did in December 2014 at $327.
Thanks, Alec. There's a question from Ivan. He wants to know, are there stocks that you're currently researching with the possibility of adding to the portfolio in the future? And if so, what might they be?
Well, I have been looking at Twitter and I have been looking at Netflix. And both of those are now looking just so much more appealing and more attractive than they were before. But we would have to move out of the Vanguard VOO and out of Berkshire to make those switches. I've also been looking at UK shares, in particular UK banking stocks, particularly a stock we used to own, Metrobank. Metrobank has really taken a hiding after the scandal, which was related to the chairman's wife being paid a fee for doing the internal design or interior design of the banks. But they've been a partnership, they're both in their 70s, and they've been a partnership for nearly 50 years. And it's unlikely that there was any hanky-panky that went, there was any nonsense that went on there or any untoward the payments that were made. But the perception amongst investors was that this wasn't the right way to do business. This wasn't the right governance. I look at Metrobank, and again, I bank with the company. They're amazing. It's an amazing bank. It's like just so far ahead of the old-fashioned high street banks in the UK. So where would you want to be putting your money if you're going to be buying a banking stock? That would surely be the one. But again, you just do your research. If the marketplace is really, really out of favor with it, that's the time to be getting quite excited. You might remember, those of you who've been with us for the whole 4 years, that when we bought into Amazon, it was just after the share price had taken a bit of a caning on some negativity that the market perceived about it. So these are the times to be buying into shares are when they've fallen out of favor, like the time to be buying Netflix would be now. Twitter would be now, but I just want to be sure that the numbers are right before doing so. The other thing that we did after the crack last month was we didn't sell Tencent and Alibaba. And thank goodness we didn't, because the underlying fundamentals of both of those shares, if it was good enough to buy them at the time we did, then it's even better to be buying them when they're slightly below the stock price at that point.
Excellent. Thanks, Alec. The next bit's a bit around ETFs. And Nkosazana wants to know how to trade ETFs. And then on that, Daniel sort of says, you get the ETF cost, but then you normally get costs on top of that through the platform with which you use, for instance, like a Standard Bank, etc., which sometimes could add, like he says, I charge $20 per transaction to an ETF on WebTrader.
You don't trade ETFs.
Yeah.
So, sorry, I don't trade. Finish. I'm not clever enough, because when you trade, you're taking on, think of this. You're not only taking on other traders, but you're taking on every stockbroker, every bank, every investment bank, everybody who's got, who likes to be a day trader, who's retired, who's got time to read and watch the share price day to day. I just don't have that. I'm still very passionate about Biznews and about working in the business that I'm in. And to me, what I can add value with, I think, is by being exposed to these companies and over many years, and to understanding the broader trends, to say, and then to doing the work that Warren Buffett urges us to do, to get to a price where I think, it's a good price to buy in. I can't tell you why. Well, I can tell you why we didn't sell Amazon at $2,000 a share, but I can't say to you that if we would have sold it at $2,000 a share, we would have been able to buy it back cheaper. Of course, with hindsight, we could have. But right now, I just love the fact that we own Amazon. And I love the fact that we own Alphabet. I've thought about it a lot, about Alphabet, or the parent of Google. And with all the headwinds that are coming against Google from the regulators, and in the negative kind of discussions that one hears about the problems that Google might be facing, and the fines that they picked up in the Eurozone, etc., I still can't bring myself to sell Google shares, because who is going to take away the search engine from them? Who's going to take away their advertising model? I'm not mad about Facebook's advertising model, because that is a very greedy model. That's a model where Facebook doesn't share with anyone. Alphabet shares. It shares and it is extremely low cost. So, and you can go through the whole portfolio like that. So there's an underlying reason. Adobe, there's a wonderful example of a company that is positioned for the future, for as more and more players get involved in the online space. Adobe is your alternative to the Amazon and Amazon is going into that market, but it's your alternative to Alphabet and Facebook as far as advertising is concerned. If you're going to have your own advertising, Adobe will give you Google type analytics for your own operation that you can sell to advertisers, for instance, on top of which they have a whole lot of other software, PDFs, being an example that why Adobe is just a fabulous long-term business. If somebody comes in and disrupts Adobe and manages to find an alternative to PDF that we all embrace, well, then you wouldn't want to be owning Adobe any longer. If someone were to come in and find an alternative to Microsoft Windows and Microsoft Office, which is going to put them out of business, then you don't want to have Microsoft anymore. But once you are these huge, big Goliaths, as long as you can retain a spirit of innovation within the company and a spirit of humility, as most of these companies somehow have managed to do because of their cultures, then it's very hard to beat them. Very hard to beat them.
Excellent, thanks, David. I think we've got time for one more question, and it's quite nice when you've got the portfolio in front of you. Ivan just wants to know, are there any stocks currently in the portfolio that you are seeing as undervalued? So probably looking at buying opportunities.
I like the two Chinese stocks, Tencent and Alibaba, because they have been influenced by geopolitics rather than their underlying value. The underlying value in both of those is tied to the Chinese market. The Chinese market is massive and continuing to grow. It might not be growing at 6.5%, or 7.5%. It might continue growing at 5%, say, but that's still wonderful growth. And both of them have hugely dominant positions there. Something that caught my eye in the past week was that 1/3 of their profits are now being generated by companies that they've invested in. Isn't that interesting? We know from a South African point of view that over 100% of the valuation of Naspers, in other words, you buy Naspers, you're actually buying 10 cents cheap, and you're getting all the rest of Naspers for free. But Naspers has got the opposite, where its investment generates well over 100% of its profits. In Tencent and Alibaba's case, as far as they have made many investments into other companies. It's like the go-to place for entrepreneurs in China and in Southeast, Asia generally, probably outside of India, but everywhere else. They go along to Tencent and Alibaba first as their first port of call, whereas the Americans would go to Silicon Valley and talk to Sequoia and some of the other venture capital funds. In China, you go and talk to Tencent and Alibaba, and they have made some spectacularly good investments and continue to do so. So now you're not just buying into companies that have got a dominant position in the biggest market in the world, but you're buying into companies that are also owners of other companies who will also benefit from the unlocking of, or the obvious unlocking of the internet as we go forward. So it's an interesting point of view. It's an interesting perspective. I like both of those, which means obviously I like Naspers. I find good value in Naspers at the moment. Adobe is a little cheaper than the price at which we bought it at, so clearly I like that one too. And Amazon, if you can get it at $1,500 or $1,600 a share, compared with having to pay $2,000 a share a little while ago, that has to be jumping out at you. Similarly, Apple, which has come back to below levels at which Warren Buffett was happy to buy into. Microsoft hasn't really moved much, so I'm quite happy to just stick with that. So my picks, if you like, of our portfolio of the stocks that offer great value right now would be the two Chinese ones, Tencent and Alibaba. I would be keen on Adobe, very keen on Amazon, and also very keen on Apple.
Excellent. Thanks, Alec. I think we can end it here. We'll try to get the, not transcription, we don't do that, the audio onto the premium section as soon as possible this afternoon for the listeners if you've missed anything. And the presentation will also be up on the site as soon as possible.
Yeah, and just one last thing. Please don't trade this portfolio. Please, if you're going to invest in this portfolio, look at it as a 5-year investment. We now know over the last 4 years, those who came in at the beginning have made 28% compound per annum. That's a ridiculously high number. It's unlikely that you're going to make those kind of returns in the next 5 years. But it is a portfolio that is positioned for a transformation in the world. And that's really what you're betting on here. So if the world continues to transform, and there's no reason to think that it isn't, and that it won't be transforming as rapidly as it has been, as it continues to do that, this portfolio or these stocks should outperform. However, we'll keep watching them. We'll keep our eyes on them. And if there is a reverse for any reason, as happened with those 6 shares that we have sold over the last 4 years, then we would be urging you to follow us out of them at the same time. I hope that kind of puts it in perspective, and look forward to the next month.